Investing in the stock market can seem like a daunting task, especially for those who are new to it. But it doesn't have to be. With a bit of knowledge and a careful approach, anyone can make smart investment decisions that can lead to great returns. One of the key things to keep in mind when investing in the stock market is to look beyond the abstract numbers and instead focus on the dynamics of a company's performance. This means taking a closer look at the trends and patterns of a company's financials, including its revenue, earnings, and other key metrics, to understand how the company is performing over time. Get ready to discover the power of understanding the dynamics of key indicators and how they can lead you to make smart financial decisions. Don't miss out on this opportunity to elevate your investment game. The first and most important thing to assess in a company is the dynamics of its key indicators. To do this, you will need to obtain data for the last 5 years. There are many great services on the internet that will help you with this data. After you have data for the last 5 years, it is necessary to properly assess it and make the right conclusions. An ideal company is one where assets, revenue, net income, and dividends are growing, and liabilities or debts are decreasing. There are very few such companies, and if they exist, they are usually very expensive. But you are obliged to know such companies just in case some nonsense happens and the stock price of this company will fall. Then you will be able to buy an ideal business at a silly price. We will explain in the next lessons how to understand that stock price does not reflect the quality of the business. Besides the ideal company, there are also intermediate options. For example, if you find a company whose revenue, income, assets, and debt are growing, there's nothing scary about it. Obviously, in front of you is a growing business that actively captures the market. It's ready to take loans to capture as much of it as possible. Such companies don't pay dividends and direct all of their net profit to business development to capture more market and continue to grow. For example, Apple spent a lot of resources researching the market and creating the iPhone. If they had paid dividends, they might not have created it. These companies should also be kept in mind, and one can even afford to overpay for their shares, as the company will be larger and have a larger market and the value will eventually catch up to the price after a year. If you find a company that does not pay dividends, has growing debts and decreases revenue and net income, then this is an example of an inefficient business. It appears that the company's management is not paying dividends to shareholders, but instead directing them to projects that do not reflect growth in revenue and net income. In other words, they are simply not needed. It is better not to deal with such a company. However, there are some assumptions that could justify this business, but I would not recommend doing so. You can be picky and choose the best from the available stocks. Investing in this way will bring much more peace of mind, especially during the first year. Look for trends, look for patterns in the company's financial data, such as increasing or decreasing revenue, earnings, and margins. This can help you understand how the company has been performing over time and whether it's headed in the right direction. Compare the company with its competitors. It's important to understand how a company is performing relative to its peers in the industry. This can give you a better understanding of its market position and whether it has any competitive advantages. Often on the stock market, you can find companies that are not growing in assets, revenue, and net income, but they pay dividends. These companies should be treated as a deposit in the bank. If the price significantly decreases, then you can purchase such dividend papers. We have recorded a good video on our channel on how to do it correctly. If a company has shown a loss for more than 3 years, we do not recommend getting involved with it. This loss may be one-off, accidental, or even accounting related, it doesn't matter. A loss-making business has very few prospects. The time will come when you will feel confident and then you will invest in such risky projects, but definitely not in the first year. By taking the time to understand the performance of a company, you'll be better equipped to make informed investment decisions. This can help you to avoid potential pitfalls and ensure that your investments are aligned with your financial goals. In this video, we discussed how to determine the company in front of us based on the main indicators, and there will be a small homework. Watch interesting companies for the growth or decline of the main indicators and write down in a notebook those that you like the most. This list will come in handy for you throughout your life. The investor will have to compare this list with the situation on the stock market. Maybe the chance will give you the opportunity to buy these securities very cheaply. Stay tuned for more insights and tips on investing wisely as we delve deeper into the world of finance. In the next video, we will uncover even more secrets of successful investing, So make sure to subscribe to stay updated. Trust us, you don't want to miss out on the action. See you in the next video.